Hi, I'm Stuart Porter, Chartered Financial Planner based in the United Arab Emirates, specialising in providing expatriate financial planning advice. With the recent collapse of the cryptocurrency exchange FTX due to a multi-billion-dollar hole in their books, cryptocurrencies are once again back in the news. Whilst FTX was best known as a cryptocurrency exchange where people bought and sold cryptocurrencies, it could also be used to trade other assets such as exchange traded funds, ETFs, and more esoteric non-fungible tokens or NTFs. Therefore, I thought this would be a good opportunity to review the white paper that I issued to clients about 6 months ago. So let's start by understanding what cryptocurrencies are. Cryptos are a digital, sometimes called virtual asset, designed to work as a medium of exchange. They use cryptography to secure transactions, to control the creation of additional units, and to verify the transfer of assets from one owner to another. Cryptocurrencies are decentralized. This means they are not subject to government or financial institution control or oversight. So, how many cryptocurrencies exist? This is a globally unregulated market with low barriers to entry, so it's difficult to be precise. Growth in the number of cryptos has been almost exponential in recent years. Bitcoin was the first in 2009, but by 2013 there were 66. As of February 2022, the website Statista.com estimates that there are over 10,000, with other websites estimating as many as 18,000 available within the global market. Most of them are not traded regularly, and it's estimated that the top 5 cryptos account for over 75% of the global market value. So now we know what cryptocurrencies are, and we also know how many of them there are. How big is the cryptocurrency market? In November 2021, it peaked at around 3 trillion US dollars. As at the time of recording, a year later, in November 2022, according to coinmarketcap.com, the global market capitalization of all cryptocurrencies was just 830 billion US dollars. That's down by over 70% in the course of the last 12 months. To put the size of the market into perspective, the global equity market capitalization is about 111 trillion US dollars, and fixed income or bonds is about 120 trillion. So cryptos are a minute part of the investable universe, representing less than 0.5% of the value of traditional investor assets. Bitcoin still dominates the market with about 38% share at the time of writing, and Ethereum is the next largest with 17%. The top 5 make up over 75% of the total market. So despite having about 18,000 crypto assets to invest in, the market is highly concentrated in just 5 assets. This is important as the risk associated with being invested in the asset class is highly susceptible to the fortunes of a small number of participants. What types of cryptocurrency exist? There are 4 main types of cryptocurrency: proof of work, proof of stake, tokens, and stable coins. Proof of work currencies, like Bitcoin, use mining to generate new units. Proof of stake currencies, like Ethereum, allow users to earn rewards for holding the currency. Tokens represent a holding and can be useful in providing liquidity to illiquid assets such as property or art. Stablecoins like Tether are pegged to real-world assets to maintain a stable value. Each type has its own benefits and drawbacks. However, as we have seen recently, some stablecoins lose their peg and can quickly devalue. Central bank digital currencies, CBDCs, are currently being considered by many countries around the world. These would be regulated and officially recognized by their governments. Often people ask, what is the best type of crypto? Proof-of-work currencies are the most well known, possibly because Bitcoin has been around for so long. They're also the most secure, as it's very difficult to create fake transactions or to forge information on the blockchain. However, proof-of-work currencies can be quite slow and expensive to transact. Each type of coin was developed for a different purpose, therefore they all have advantages and disadvantages. Governments around the world are starting to take a closer look at regulating stable coins. Earlier this year, when he was still the UK Chancellor of the Exchequer, Rishi Sunak mentioned it in his spring budget. And the SEC in the US are also considering how this may be achieved. While some believe that these digital assets could help promote financial inclusion and stability, others are worried about the potential impact on monetary policy and financial stability. There are a variety of reasons why governments may want to regulate stable coins. For one, stable coins could potentially be used to launder money or finance crime. Additionally, if stable coins became widely used, they could have an impact on a central bank's ability to control inflation and manage monetary policy. So far, no country has announced plans to ban or heavily regulate stable coins. However, it's likely that we will see more governments taking action in the near future as these digital assets become more mainstream. What is the blockchain? There's sometimes confusion over what the blockchain is and what it does. The blockchain is an underlying technology that powers cryptocurrencies like Bitcoin. The blockchain is a distributed database that stores information about all transactions that have ever been made. This makes it possible to track ownership of digital assets and to keep track of any changes that have been made. This factor makes stealing cryptocurrencies tricky, as, theoretically, checking the blockchain will tell you where it's gone. The blockchain is constantly growing as new blocks are added to it, and each block contains a timestamp and a link to the previous block, making the chain. What are the benefits of investing in cryptos? Cryptocurrencies are a new and exciting asset class. They are a relatively new phenomenon and as such offer investors the opportunity to get in on the ground floor of a potentially game-changing technology. They are volatile. The prices of cryptocurrencies tend to be very volatile, which can lead to large gains or losses in a very short period of time. This volatility can be both good and bad depending upon how you approach it. Cryptocurrencies know no borders and can be bought and sold anywhere in the world. This makes them an attractive investment for those looking to diversify their portfolios beyond traditional assets. They are decentralized. They are not subject to the same regulations and controls as traditional assets like stocks and bonds, and this can be seen as a good or bad thing depending upon your perspective. Cryptocurrencies offer anonymity. You can buy and sell cryptocurrencies without revealing your personal identity. This level of anonymity can be attractive to those who value their privacy. Before you go off and invest in cryptos, there are a few key disadvantages to bear in mind. First, the value of these digital assets is highly volatile, which means that prices can go up and down very quickly. This makes cryptocurrencies a very risky investment, and it's important to understand the risks before investing any money. Secondly, there's still a lot of legal uncertainty surrounding cryptos, which means that regulations may change in the future, and this could impact the price of these assets. Finally, there is also the risk of loss, because you can no longer access your wallet or account. We've all read stories of people buying into Bitcoin years ago and forgetting their passwords. Overall, investing in cryptocurrencies is a very risky proposition. One of the questions I'm often asked is whether cryptos offer a hedge against inflation. When I last spoke about cryptos, inflation was starting to rise. Now, with inflation in double figures in many developed markets, it's a significant concern. Whilst cryptos do have the potential to hedge against inflation, as they're not subject to government control or manipulation, the last 12 months have not shown them to be a good store of value in fiat currency terms. This is because we've seen huge losses since the start of the year. At the time of writing, Bitcoin is down over 60% since the start of 2022. Another question I'm asked in connection with cryptos is whether they reduce risk in a portfolio. In order for an asset to reduce risk in a portfolio, it needs to be not perfectly correlated with the other assets already held by the investor. Correlation can be positive, i.e. when one asset goes up, so does the other, or negative, here assets move in opposite directions. Correlation is measured between +1 and -1. If a pair of assets has a correlation of +1, then one moves up by 5%, the other will also move up by 5%. If the correlation is -0.5 and one asset moves up by 5%, the other would move down by 2.5%. Portfolio construction involves pairing assets together which have low correlations to reduce risk and maximize returns. There is a lot of noise in the pricing of cryptocurrencies. However, currently the correlation to shares or equity markets is quite strongly positive. There is currently no reduction in risk from an asset allocation perspective of holding cryptos. Therefore, what type of investor would normally buy cryptos? A recent survey of 1,000 investors aged 18 to 29 by Interactive Investor, a UK investment platform, revealed that the first investment for 45% of them was some form of cryptocurrency. Investing in cryptocurrencies is high risk. It may be suitable for those who have a good understanding of the technology behind it and who are psychologically and economically able to withstand the loss of their investment. Even then, very few people are investing more than 1% of their liquid assets, and most are investing for the long term, not seeking to make a quick buck. If you're wondering how to invest in cryptocurrencies, there are a few different ways to do it. One popular method is to buy Bitcoin or Ethereum through a cryptocurrency exchange such as Coinbase or Binance. Another option is to purchase a digital currency wallet, which allows you to store your coins offline in a secure location. Finally, you can also invest in initial coin offerings, ICOs, or security token offerings, STOs, though these tend to be at the more speculative end of an already risky asset class. Whichever route you decide to take, be sure to do your research first and always invest responsibly. Due to the unregulated nature of these assets, few traditional financial institutions have been willing or able to offer access to these assets. This is gradually changing with collective investments such as exchange-traded products. Some of the longest-running products are offered in Europe by companies like WisdomTree, but more are now appearing in the US as well, with recent launchings by ProShares, Valkyrie and Grayscale. Whilst living in the UAE, we often forget about tax. However, tax is potentially an issue with cryptos. There's no definitive answer to the question about what the tax position on cryptos is, as it varies from country to country. However, in general, any profits made from trading cryptocurrencies will be subject to capital gains tax. This means that if you buy and sell cryptos for a profit, you will need to declare this on your tax return. Similarly, if you hold on to cryptocurrencies for investment purposes, you may be liable to capital gains tax when you sell them. It's important to note that cryptocurrency taxes are not always straightforward, and you may need to seek professional advice to ensure that you're correctly declaring your profits and claiming your losses. So are financial advisors recommending cryptos to their clients? The US financial markets are the most advanced in the world. A recent survey of registered investment advisors found about 7% held cryptocurrencies or indirect exposure to the asset class within their clients' portfolios. Where crypto was held, the percentage of the portfolio represented was very low. However, these assets were often held at the client's request, not at the advisor's recommendation. Registered investment advisors are restricted in what they can recommend to their clients by their regulator. UK advisors are also not permitted to recommend unregulated investments to most of their clients. However, the survey found the majority of advisors have received requests from clients due to the amount of media coverage. That concludes my short presentation on cryptos. Cryptocurrencies are becoming increasingly popular. However, there remain major risks associated with investing in this asset class. There is no protection if something goes wrong, such as a fraud or theft. With up to 18,000 different types of coin available, some have compared it to the dot-com bubble, where most of the companies went bankrupt and were never heard of again. Undoubtedly, there will be a few which will survive in the long term, but few would have correctly guessed the survivors of the dot-com crash in the mid-1990s. This means cryptos is not a place to invest money which, if lost, would impact your financial well-being. I hope that you found this presentation useful and informative, and if you would like more information, please visit my website, stuartporterfinancialplanning.com, and thank you for watching.